If you're in real estate, 2025 just became a whole lot more profitable. The One Big Beautiful Bill Act had a number of provisions in it related specifically to real estate. We're going to cover each of those 7 things. We're also going to talk about the 3 things that received a lot of talk that did not make it into the bill. We're going to talk about different scenarios where this can play out and give you some real information on how it can help you. The One Big Beautiful Bill was massive, over 1,200 pages of legislation. I spent the weekend scouring through it as best as I could to look for the parts that impact real estate, and we're going to bring those to you specifically. We are not going to talk about other parts of the bill as it is very far reaching. We're focused specifically on real estate and the tax breaks that it has in it for real estate. The first thing we're going to talk about is the 100% bonus depreciation has been restored and made permanent, and this is an incredibly powerful tool for real estate investors. So let's talk about bonus depreciation and what it means. Bonus depreciation lets you write off a huge portion of your property's depreciation in the first year. Normally, you have to depreciate the property straight line over 27.5 years. But with bonus depreciation, you can accelerate that timeline. Here's what that means financially. Let's say you buy an apartment building or a short-term vacation rental property in 2025. Through cost segregation, you can break that purchase down into parts: flooring, cabinetry, appliances, things like that. Many of these items fall in 5, 7, or 10-year depreciation categories. With bonus depreciation, you can depreciate 100% of those expenses in year 1. So instead of spreading out $200,000 in deductions over decades, you take it up front, maybe $60,000 or $80,000, depending on the property, all in year 1. What does that do? It reduces your taxable income, possibly down to 0. Additionally, if you qualify as a real estate professional or use the short-term rental loophole, you may be able to even use your loss to offset gains in your day job or other business income. That's real money in your pocket today, not 30 years from now. That's why bonus depreciation is such a big thing, and it is permanent through 2030. And it is something that is very powerful, one of the most powerful tools a real estate investor has in their pocket. So let's look through a scenario. You buy a $500,000 duplex. After cost segregation, you find that 120 of that can be depreciated in year 1. If you're in a 35% tax bracket, that's $42,000 off your tax bill right out of the gate. Next is the Section 179 deduction. Section 179 allows you to deduct the full value of certain business-related property in the year you buy it instead of spreading it out over time. Thanks to the new bill, the cap was just raised to $2.5 million, with phase-out starting at $4 million. For real estate investors, this means major things like new roofs, HVAC systems, things like that, in rental or commercial buildings can all be deducted as long as you're treating the property as a business with like short-term rentals or LLCs. Here's the bottom line. If you buy a property and decide to do these upgrades, you may be able to write off 100% of the cost of the upgrades in year 1 under Section 179. That means better cash flow, lower taxes, and more incentives to do those upgrades right away. Section 179 is no longer just for major investors. It's something that can be used by regular investors now, and that's a big change. Let's look through an example of how Section 179 could work for you. Let's say you finish a short-term vacation rental with $30,000 worth of new furniture, appliances, a ductless AC unit. If it qualifies, you can deduct all $30,000 under Section 179 instead of depreciating it over 5 to 7 years. Always check with your CPA. Not all properties will qualify. Number 3, this is another tax win for real estate investors, and that is the QBI, Qualified Business Income Deduction for real estate. If you own rental properties through an S Corp, LLC, or as a sole proprietor, the QBI lets you deduct up to 20% of your net income, even if you're not a real estate professional. Before the One Big Beautiful Bill, this was set to expire in 2025. Now it's permanent and even better because the phase outs were raised. This means more investors can qualify even with higher earnings. Here's the key. Your rental activity has to qualify as a business, not just passive investment. If you're actively managing, cleaning it, hiring professionals, you likely qualify. So let's say you buy properties and you have $100,000 in income from these properties. You can can write off $20,000 right off the top without even buying anything new. It's one of the cleanest, easiest deductions in real estate investing today. Let's look at a scenario with that. You earn $80,000 in rental profit across 3 properties. With QBI, you can deduct $16,000. If you're in a 32% tax bracket, that saves you $5,000 in taxes just for owning and managing property as a business. QBI eligibility can get very technical, so again, check with your CPA to see if you qualify. Next, let's talk about 3 things that received a lot of attention in the press beforehand, but did not make it into the one big beautiful bill. The biggest one would have impacted just about anyone who owns real estate and not investors, but it did not make it in. And that was raising the capital gains exemption from $250,000 for single people and $500,000 for married people to $500,000 and $1 million respectively. Now, when this was placed into service in 1998, it was a big win for homeowners. But in that time, the median price of housing in the United States has tripled, while the capital gains exemption has remained the same. The proposal would have also allowed this to be indexed for inflation, so it would go up every year. But unfortunately, this did not make it into the final version of the bill. So we are still at the $250,000, $500,000 capital gain exemptions for the sale of your primary property. This one would have really helped a lot of people and not just real estate investors. So it was disappointing to see it not go through, as most of the provisions in the one big beautiful bill really only apply to investors. The next thing that received a lot of press beforehand was having the federal government somehow step in and lower the cost of permitting and land development. Really, this was a bit of a talking point that didn't have much of a shot in the first place, because truthfully, local municipalities have home rule over each of these situations, whether it's your state, your county, or your city government. So there's really not much the federal government could do. The third thing that did not make it into the bill that had a lot of press beforehand but was wildly unpopular was opening up federal lands for housing. Very few federal lands are in population centers that would make sense for housing, and this was met with widespread bipartisan outrage, as people both on the left and the right did not like the idea of public lands where they recreate being used for housing, for development. This one didn't have much of a chance, and when they tried to make some changes to it, the parliamentarian found in the Senate that it did not qualify under the Byrd rule, and it was quickly removed from the bill. The number 4 thing in the big beautiful bill that helps real estate investors was that it advanced affordable housing and CRE incentives. If you're an investor focused on affordable housing, the big beautiful bill just made things a lot more attractive for you. Let's start with the low income housing tax credit. This is the number 1 tool for advancing affordable housing in the United States and investment in that, and right now it's been supercharged. The bill increases annual allocation to states, expands the pool of qualifying projects, and even makes it easier to finance multi-family transactions. Let's also talk about opportunity zones. These are areas set aside where you can invest capital gains and defer the taxes, and in some cases eliminate them completely on housing projects. Under the new law, the opportunity zone rules were expanded. There is much more flexibility to how the funds are deployed, broader eligibility for mixed use, and also loosening the timelines to reinvest. So if you're sitting on large capital gains, 2025 might be a prime time to reinvest those, especially in areas that are primed for revitalization. Let's say you sold a property in 2024 with a $500,000 gain. Under the new opportunity zone rules, you roll that into a qualified project in 2025, potentially deferring taxes until 2029 and eliminating any gains on the new project if you hold it long enough. Remember, opportunity zone investments carry risk. Do your due diligence and work with tax and legal professionals on this one. Let's move on to number 5, and that's the 1031 tax deferred exchanges, one of the most powerful tools in real estate that investors have used, large and small, for a long time. One of the biggest questions that investors had coming into 2025 is, would the 1031 exchange rule go away? And the answer is no. A 1031 exchange allows you to sell a property and roll the gains into a new property, deferring your taxes. The rules are very strict and you have to meet those. There are no oopsies or second chances on deferring your taxes, but you can roll the profits of one property into the next property by using a qualified intermediary. This has been used for a long time, and I have completed dozens and dozens of transactions with people who were buying and selling on 1031 exchanges. When you put this together with bonus depreciation, Section 179, and the QBI deduction, this might be a year to sell a piece of real estate investment and buy the one that you've had your eye on. Because by placing the property in service in 2025, you now qualify for all these new programs. You don't qualify for these programs for property that you already hold. This is why 2025 might be the year to sell a piece of investment property that you've been holding and buy the one that you've had an eye on. These new tax rules come into play for properties put in service starting in 2025. So you will not be able to do bonus depreciation and all these other things on properties that you already hold, but you will be able to do it on properties that you purchase moving forward. That's why this may be a huge year for real estate investors. And this is the time for me to tell you, if you are looking at buying or selling a property anywhere in the United States of America for your real estate investment, I can put you in touch with our network of real estate professionals who are seasoned at doing 1031 exchanges and can work with you to meet your goals under the timelines required and work with the qualified intermediaries that you need to make sure you take advantage of this full suite of tax savings that are out there right now. I'll have a link down in the description to get in touch with me and put you in touch with a real estate professional who specializes in 1031 exchanges. Number 6, the short-term vacation rental loophole is alive and well in 2025. This is one that a lot of people have used quietly to slash their taxes for years. Thanks to the new bill, this one just got a second wind, and it's something you should take a look at. Not a lot of people know about it, and it is a wonderful strategy that you can use to offset some taxes. The new law brought back 100% bonus depreciation and kept favorable treatment for certain active investors. And if you're operating a short-term rental, you may be able to use your losses to offset your active income, which is a powerful, powerful tool. Here's how it plays out. If you own an Airbnb or VRBO type property and you materially participate, meaning you're involved in running it, you can take paper losses from bonus depreciation and apply them to your day job income, your consulting income, even your W-2 wages in some cases. This is a legal and powerful strategy. It's not about cheating the system. It's about using the system exactly as it was written. And the combination of bonus depreciation, cost segregation, and this STR loophole can result in tens of thousands in tax savings, even if your property is profitable. Now, you'll need to make sure you're documenting your time and hours spent on the property. This is absolutely key. Let's look at a scenario on how this one works. You buy a $700,000 short-term rental and do a cost segregation study. You get $150,000 in bonus depreciation. That's $150,000 loss on paper. If you actively manage that rental, that loss can offset your $150,000 in business income, bringing your tax bill all the way down to zero. Now, this isn't a gray area. This is black and white, but you will need to follow the rules exactly, and you absolutely need to work with someone who specializes in this as a CPA to make sure you're doing it the right way. The IRS scrutinizes this one very closely and often triggers audits based on it. If you want to know if your property qualifies, I'll have a link in the description below, and I'll send you a short-term rental loophole checklist to make sure if you qualify before you take it to a tax professional. Again, the rules are strict and you will absolutely need to document everything. And finally, number 7, this will only apply to a few people, and this gets a little bit of criticism. This is one of those tax incentives that applies to the ultra wealthy people, and it is extremely powerful for 2025. Let's go into the details on it. If you own a lot of real estate and you're going to pass your property on to family members, this is one you're absolutely going to want to pay attention to. The bill permanently increased the estate and gift tax deduction to $15 million and indexed it for inflation moving forward. This means that a married couple can pass on $30 million in real estate investment and gift taxes upon death for free to their heirs. This is huge for some of our large real estate investors. Let's say you own a few apartment buildings, maybe some land, maybe a couple short-term rentals, and your total estate value is creeping past 10 or 12 million. You were probably sweating the old sunset date in 2026, but now you've got a lot more room to plan your gift without triggering the 40% estate tax. Let's look through an example of how this plays out with the numbers, and you'll see how incredibly powerful it is. Let's say you own $28 million in real estate, apartment buildings, commercial properties, a vacation rental or two, and you want to leave it to your kids. Under the old rules, the estate tax exclusion was set to drop back around $6 million per person in 2026. That would mean that $16 million of your estate could have been taxed up to 40%, a tax bill of over $6 million. But with the bill, the exclusion is now at $15 million per person, so $30 million for a married couple. With smart planning, your entire $28 million real estate portfolio can now be passed 100% tax-free, saving your family $6 million in taxes. And that is how you pass on generational wealth to your family. These changes to the tax code just opened the door to real estate investing, and now it's up to you if you're going to walk through it. These new changes could mean tens or hundreds of thousands of dollars for real estate investors in tax savings, and this is expected to really push the investment property market forward. If you found this video helpful, please leave a like, a comment, and subscribe. I'd like to find out which of these do you think is going to be the most powerful for real estate investors in 2025. This really is going to be a game changer in the real estate investment category if you take advantage of it. Again, I think one of the most powerful things in here is the ability to sell your current real estate investment holding, implement the 1031 exchange, and buy a new real estate investment property this year and take advantage of all of these things to lower your taxable income. Thank you so much for tuning in, and I'll see you again next time.